Welcome to this week's episode of the Retirement Compass, the show that's dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and I'm joined today by two members of the team from Stonebridge Wealth Management right here in Nebraska. We have Tim Kulhanek, he is founding partner and financial advisor, and Jeremy Gove, senior financial advisor. Tim, Jeremy, it's always great to be with you. Good to see you again. How are you?
Good to be back. Doing real well. We are into all kinds of activities at our house with sports and watching volleyball, so lots of entertainment these days.
Oh yes, for sure. And Jeremy, how about yourself?
Likewise, I got two daughters that are growing up way too fast and just busy. One of them has a boyfriend now, so got to start cleaning the guns and stuff like that. So
yes, a new phase has been entered, right?
Yes.
Oh, well, we
Difficult
appreciate your time and being here. And I know that your heartbeat of what you do at Stonebridge Wealth is really providing solid financial education and helping folks navigate the complexities of retirement. We've talked on previous shows that retirement today is very different than it was for previous generations. And we were talking prior to the show. And I love that you had this phrase that you don't want to be using 20th century solutions to fix 21st century problems, especially when it comes to investment planning. So let's dive in to start with that. You know, the reality is 2022 brought a really rude wake-up call for a lot of folks. And the bond market alone, the worst year it's had in history. And it was the first back-to-back loss for the aggregate bond index since its inception in 1986. So what should investors who are just worried about what they have just come through in the markets and current market volatility, what should they be doing right now?
Well, I think, as you mentioned, there's a lot of worried investors. And I think the key, anytime that you're looking at your portfolio or looking at statements, don't panic. You're not going to lose everything overnight. Hopefully you have a strategic plan for that. But you're right, bonds did have a terrible year in 2022. And it wasn't really that big of a surprise, though. If you think of a teeter-totter, the way bonds work, if interest rates start going up, bond prices go down.
Right.
And so what was happening prior to 2022? We had the Fed saying they're going to start raising interest rates. And so it wasn't a big surprise that bonds came down. And so, but it did substantially hurt people because it's kind of a unique environment when you have stocks and bonds both going down at the same time.
Right, that was the shocker for a lot of folks that they didn't realize, because typically those have an inverse relationship, but now they both went down. Yeah,
and so typically they're not correlated like they happen to be in 2022. In 2008, they did do the same thing. And so
the third time that's happened in the last 100 years, by the way.
Right, which is why it's not on the top of people's minds that this is going to happen.
Yeah. And so I think the biggest thing is just to have a plan in place. You know, there's going to be different circumstances that come forward. Nobody knows what's going to happen tomorrow. So what we are trying to focus on is just having a plan in place so that we can keep moving forward and making adjustments to portfolios based off of the economic news that we have in front of us.
Well, I'm curious. I mean, I know none of us here at this desk advocate panicking. We don't want people to panic, especially when it can be avoidable by getting a solid plan in place. But for people who might be watching who did sustain some losses last year, what would you recommend as their next course of action?
Yeah, I think we have to look at whether or not people are able to stick to something long term. And oftentimes what we find is the reason why somebody doesn't stick to their plan, if they have one, is there's a mismatch between what their actual tolerance for risk is and what their actual portfolio allocation is. And that's where we get into using those 20th century tools. You know, in the 1980s, you could buy a bond fund and yields were sky high. You'd make a ton of income. Plus, as interest rates fell, because, just ask our viewers, most of them probably paid double-digit interest rates on their first home, right? Yes. A lot of folks paid 12, 13, 14%. I've heard higher than that. Well, as Jeremy explained, that teeter-totter effect during the 1980s and the 90s, as those interest rates came down, those bond values came up, everything was great. Again, it was hard to screw it up at that point. But those tools that worked back then aren't working today. And unfortunately, what most people do is they get into this cycle where when things go bad, that's when they sell. Right? And when things go good, that's when they buy. That's the exact opposite of the most basic axiom of investing, which is buy low and sell high.
Right.
And they just do it over and over again, unfortunately.
Well, and I think it's that emotional component. We've mentioned this before, that behavioral finance component, if you will. It's sometimes hard to remove the emotion from the equation when you see the volatility and you see what the markets are doing. But then people end up, to your point, doing the exact opposite of what it is they're supposed to be doing to stay the course.
Yeah, and there's plenty of research to back this up. There's companies out there like a Morningstar or Dalbar who has their quantitative analysis of investor behavior, and the results really never change. So believe it or not, the average stock investor gets about half of a unmanaged benchmark, so like the S&P 500's return. They get about half of that because of the decisions they make.
Right.
And the average bond investor gets a little bit less than half of that. So this is literally costing folks, these poor decisions, it's costing folks hundreds of thousands, millions of dollars over their lifetime in potential earnings or income because they're making the wrong choices at the wrong time.
Right. So how do you prevent this from happening? I mean, let's talk about this on a very practical level, because I think a lot of times we hear that, right? We all know we're supposed to buy low and then sell high, but so many people are doing the opposite. So how can that actually be prevented?
Well, I think the key is, and we're going to beat this like a dead horse, the key is to have a plan. I mean, when you have a plan in place, you're taking into account situations like this. You know, we know interest rates are going to go back up at some point. We know they're going to go back down at some point.
Right.
And so we have to have a plan so that we can stick to it and not make emotional decisions. And I think that's the critical piece, because so many people that I meet with, you know, the market, let's say as an example, a new client that I'm meeting with, the market's coming crashing down, or like at the end of 2022, they're wanting to sell everything and just move to cash.
Right.
And if they would have done that, they would have missed the first quarter of growth that actually happened in 2023. And like Tim said, the axiom is you buy low and sell high.
Right.
And you see people do that all the time, where they're buying low or buying high and then they're selling low.
They're doing the opposite.
They're
I know it's easy to get.
Yeah, I'm mixing myself up because we're just doing it backwards.
Yes.
And so it seems like it's just common sense to do that, but when you get emotions involved, it becomes very difficult. And I think we're all emotional people, right? We have emotions, and especially when it comes to money. We don't want to lose money. And that's why having an advisor that can take an objective view and can take a step back, they're not emotionally tied to it. We want your well-being, we want the best for you, but we're not emotionally tied to it. That makes a big difference.
Yeah, that independent, objective point of view, right?
Yes.
Well, you always have, both of you, a wealth of stories of people you've been able to serve and help. So before we have to go to the first commercial break, I'm curious, Tim, does anyone else come to mind of someone you've helped navigate through this exact scenario?
Absolutely. So I think what's interesting is it's not just, we talk about, our emotions get the best of us. Unfortunately, it's not just the DIY investors that are having this problem. Unfortunately, a lot of financial professionals are actually exacerbating or causing the problem because, again, we're all emotional human beings. And because we don't put a plan in place and stick to it, we all have a hard time sticking to things. We have an attention span of 14 seconds or whatever it is.
I think TikTok's made it even less, right?
I would agree.
Right.
So again, what we do is we make sure that whether it's you that are having a hard time with it, or maybe the person that you've hired that doesn't have a system in place, like a Stonebridge Wealth system, in order to avoid this, we're able to come in and make some tweaks to your plan and make sure that we match your risk tolerance to an appropriate portfolio, so that way you can stick to the plan.
Right.
And that's really what we're talking about, not only for the folks that come in for our current clients, but all our viewers out there. It is part of the Retirement Readiness Review. It is the 5-point Stonebridge Retirement Compass process, where we look at income, investment, taxes, healthcare, and legacy. So this is what we're talking about, investment plan. So if you have a plan in place, great. You have to have a second opinion to make sure you're on the right track. We're happy to do that for you. Give a call to the number on the bottom of the screen, and we'll look forward to seeing you soon.
Wonderful. Tim, Jeremy, thank you so much. I know we have a lot more to get into today. I'm so excited to have this time with you, and we appreciate you watching at home. We are going to take a quick commercial break, but again, that number to call to get your own complimentary retirement readiness review is there on the bottom of your screen, 866-256-7778. You're also welcome to take out your smartphone. Simply scan that QR code in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few simple questions, and a member of the Stonebridge Wealth Management team will reach out to to you to schedule your complimentary retirement readiness review that way as well. When we come back, we're going to be diving into what is a 20th century portfolio. Is yours stuck in last century? Stick around and we'll find out right after this.
Good morning, Ben.
Good morning, Ben. Hey, birthday party for Carol and 5. Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there every square. Happy birthday to you. As you can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back, Nebraska. You're watching this week's episode of the Retirement Compass, helping you successfully navigate to and through retirement. I'm your host, Kristen Oakley, and I'm joined by Tim Kulhanek and Jeremy Gove from Stonebridge Wealth Management. You know, we opened the show today talking about how we don't want to be using 20th century solutions to try to fix 21st century problems, especially when it comes to investing in our current investment plan, because we all know that the retirement landscape has changed significantly. I can't get my words out here today. But anyway, I wanted to ask, I've heard you use this term. Do you have a 20th century portfolio? And I think it's really important for our viewers to know what you mean by that. So let's start with that.
Yeah, so I call that a portfolio using traditional asset classes. And not to get too technical with it, but effectively, you know, when people come in and they've got mainly mutual funds in their portfolio, and it's maybe 60% and more stock mutual funds, and there could be US stocks, and there could be international stocks, and mid cap and small cap, and growth and value, you know, there's a blend there. And then the other 40% is in bond funds, and it could be corporate bonds, government bonds, high yield bonds, municipal bonds. Again, there's a blend there, but what we find is with that 20th century solution, you get a lot of overlap. We call it correlation, but basically you have a lot of different pieces that are all doing the exact same thing. And so what happened last year? I mean, folks viewing right now, you saw your statements. You know, you thought you were in a portfolio that was supposed to be moderate risk, but you lost 17, 18%, and you're scratching your head wondering why. Well, that's why it wasn't the right tools. Again, as independent fiduciary advisors, we have access to a broad range of tools. There's things, the financial services industry has evolved as the financial landscape has evolved. You just got to make sure that you're using a portfolio that keeps up with that.
And I think what's interesting, that 60-40, when we talk about, there's acronyms all the time, there's jargon in this industry, and that's something you might very well have heard of, oh, I have a 60-40 portfolio. So that's how you're really defining that's a 20th century thing, because it just doesn't work in today's environment. Yeah,
there's a whole other universe out there, and you know, just not too far back, maybe a couple months ago, a gentleman came in, he heard us on the radio program, and he was working with an advisor from out of state who actually is another radio program, and he's a large organization, syndicated, and what he was frustrated with was this. He says, Tim, every time the market goes down, I feel like my portfolio is late to adjust. So after the market goes down, my portfolio gets more conservative, okay? And then it goes back up, and after it's gone back up, I get more aggressive. So I'm constantly catching up, trying to catch up. But what we know is the worst days and the best days in the market, guess what? They live next door to one another. They're often neighbors. So if we're doing too much shifting around, that can actually be detrimental to our overall success. We just have to make sure that we have that other 21st century portion of our portfolio that's designed to weather these storms. And he didn't have that.
Right. You know, I've heard that stat, and I can't remember the exact window of time off the top of my head, but if you miss just sometimes the 3 best performing market days over a multi-year period, you've missed all the gains.
Yeah.
And that's why jumping in, jumping out, market timing just simply does not work.
Correct.
Yeah.
Yep.
Yeah, absolutely.
Well, Jeremy, I'm curious. So the landscape, as we've said on this show many times, of retirement has changed, is changing. So what tools are really available to help address this? Because you mentioned that, right? As independent fiduciary advisors, the world is your oyster. You're not limited to certain investment products. You're able to really look at what's best for an individual. So what are some of those tools that you employ for your clients?
Yeah, well, thankfully, the financial services industry has changed actually really dramatically over the last 2 years. And when you think about, like Tim was talking about with the 60-40 portfolio of just typically using mutual funds and bond funds and stuff like that, now there are other products out there that are using options. We used to have to do this for clients that we were limited. They had to have like $1 million in order for us to be able to do this in one fund or one investment. But they're basically hedging. And so we're investing in, let's say, the S&P 500, but we have a buffer built in. We use the term loosely as a buffer, where you have downside protection. And so it allows us to stay invested, but still try to protect that portfolio from the downside. And so typically the downside protection could be 20%, it might be as much as 30% in some cases, but it gives us a solution to a problem that we really haven't had in the past. And like I said, unless you had millions of dollars to invest.
Right. Well, and I'm guessing too that another issue I know I found that folks don't realize what it means to be truly diversified. You know, a lot of times I think people think, oh, I'm diversified because I have stocks and bonds, or I'm diversified because I have 5 different mutual funds. But when you unpack that, if each mutual fund is invested in the same companies, you're not diversified. I mean, do you find that's a wake-up call for folks too when they come in and get a review from you all, that they find out, oh, maybe I'm not as diversified as I thought I was?
Yeah, absolutely. And we have tools that allow us to find that out, kind of peel back the outer layer of the onion and find out, do you truly have diversification? And so there's different names for it. We call it, again, a correlation matrix, where it'll look at, well, what are the actual stocks you own? Because if you have ABC Growth Fund and XYZ Growth Fund, and they all own, you know, Apple, Amazon, and Tesla, or the same types of companies, they're going to go up and down at the same time.
Right.
Not specific advice, obviously. As I say, mileage may vary. But we want to make sure that we have true diversification. So if some things are going down, well, other things are actually going up. That's actually a diverse portfolio.
Right.
And again, it failed last year. It didn't work like it had in the past.
Absolutely. Well, do you find that a lot of folks who are trying to do this on their own, what kind of things are they actually doing? Well, you know, when they're trying to navigate this on their own?
Yeah, the reality is they really aren't. You know, most people that try to do it on their own, they just stick to one thing. So what I often find is people pile into the S&P 500. So they'll have 60% of their money in just one index fund, the S&P 500, and then maybe 40% in the aggregate bond index. Again, it didn't work out last year, and what we're finding is we're getting a more and more concentrated market. You have a situation where the top 6 companies in the S&P 500 make up over 25% of that market cap weighted index. And then you bring in the emotional component. And you know, we were talking earlier about Titanic, right? Remember the conversation, the movie?
Right.
But we were saying, well, who was the captain? His name was what? Edward J. Smith. And the question I had was he warned ahead of time, before they went sailing into the North Atlantic, about icebergs?
Icebergs, yeah.
He was, right? Did he know that there weren't enough lifeboats? Sure, he did. Did he know that there weren't enough life jackets? He did. So did a lot of the passengers.
The architects did, the passengers
all of them did.
Second in command did,
Exactly, but what did they do?
They went anyway.
Full steam ahead. They went anyway, right?
Yeah.
That's the same thing that tends to happen when you have a bull market. We get this euphoric feeling. We feel
invincible,
like unsinkable, right?
Unsinkable, yeah.
And unfortunately, that's not the case. And what we find out the hard way, where all of a sudden we wake up and we're down 15, 20%, and now we got to play catch up, which is a lot harder to do. It's better to avoid losing the money
in the first place
than trying to play catch up. So that's what we're offering to all the folks out there, is to put a plan together with a safety net, so that if things don't go well, if you're climbing the mountain and there's a slip, guess what? You don't fall all the way to the bottom. We don't have to be a Walinda. We can do this with some sort of buffer in place to make sure that we're going to be okay, that we're going to stay on track and not fall behind and have to play catch up. Number right at the bottom of the screen. And again, we look forward to seeing you in our office soon.
Wonderful. Tim, Jeremy, thank you so much. To our viewers at home, we are going to take a quick commercial break, but that number to call to get your own complimentary retirement readiness review is there on the bottom of your screen, 866-256-7778, or you're welcome to scan that QR code and that will get you connected as well. More with Tim and Jeremy from Stonebridge Wealth Management right after this.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with Tim Kulhanek and Jeremy Gove from Stonebridge Wealth Management, and we've been talking a lot today about staying the course. How can you make sure you're on track despite whatever craziness is going out in today's economic landscape? And you know, it's interesting because I know you work with a lot of folks who are preparing to retire, nearing retirement, entering retirement. But you also work with people who are still in that accumulation phase and still working. And it's interesting because there's over $6 trillion currently invested in workplace retirement plans, your 401ks, your 403bs, TSPs, whatever they might be. So how do you help people decide how their funds should be allocated in their workplace retirement plans? Because that's a significant decision that can have a long-lasting impact.
Yeah, what we found is workplace retirement plans are typically pretty limited. Now, let me take a step back. I'm a big fan of 401ks because, you know, you look at the IRA, you can put this year in 2023, $6,500 into that, $7,500 if you're 50 or over. That, I promise you folks, that's not going to get you where you need to go. So the 401k, yeah, if you're 401k, you're 50 or over, you can put about 30,000 in there this year with your catch-up contribution. That, now we're talking, now we're starting to get somewhere. But what we find is they're pretty generic. Companies are pretty hands-off. They don't want to take on a lot of liability, so they don't do a lot of, they don't give any advice, maybe a mild education on what the options are, but they're not going to tell you what to put the money into.
Right.
Now, for the folks that come in who maybe they're already retired and they still have their money in a workplace 401k, that's a big red flag for me. Because the way 401ks are structured with their expenses and their fees, the plan has an option. So they can either the company itself, the plan sponsor, if you will, can pay those fees, or they can pass them on to the investors, participants in the plan. Now, that cost could be like a pro rata cost relative to your balance. So if you're a retiree and you've got 800,000, $1 million plus in that 401k and it's still sitting in there, what you're doing is you're effectively subsidizing all the new younger workers by paying a bigger share than you need to be. So there's options. We can get that money into a more flexible environment within an IRA, not have to pay any taxes by doing a IRA rollover. Have a lot more investment options. We can put the safety net we were talking about last segment in place, and we can get rid of the subsidy of the younger employees. Like, all for them, but they kind of got to do it on their own.
For sure. Well, and Jeremy, I'm curious because I know I've heard of folks who have worked maybe at multiple different places of employment. They've had different 401ks, whatever the case might be, and they've left them behind at previous places of employment. What are some of the reasons why you don't want to leave that money behind and why it makes sense to do this IRA rollover?
Well, for somebody that's, you know, if you've changed jobs multiple times, one of the things that we end up seeing is the investment company, you know, it started out when you were working there, it was this company that was managing it, now it's this company, now it's this company, and it's changed so many times. So it's really hard to get information and get the statements that you need. So that's one thing, but it's when we, the idea of putting it, you're getting it out of a 401k and into an IRA, the benefit of that is you have a lot more investment options like Tim mentioned.
Yes.
I mean, in a 401k, we typically have anywhere from 10 to 20 mutual funds to invest in. And what we find a lot of times is people are investing in what are called target date funds. And the downside to a target date fund, especially if you're older, is it only adjusts the risk of that investment based off of your age. So it doesn't take into account any other things other than your age. And so as you get older, it takes less and less risk. Well, in 2022, that was a problem because we ended up going from a portfolio of 60% in stocks and 40% in bonds to maybe 60% in bonds and 40% stocks when you don't want to do that because they're raising interest rates. And so that's why we always recommend, if you have the opportunity, roll it over. There's no tax consequences to it. And then you can also take advantage of potentially doing Roth conversions down the road as well.
Yeah. Do you want to hit on that a little bit before? I know we only have a couple of minutes left in the show, but Roth conversions, why that's a valuable strategy?
Sure. It's a little bit of a teaser for
a future show. We could do a whole show just on that, right?
Absolutely. So here's what I'd say. According to economist and I think Brown University professor, his name is Larry Kaltikoff, the United States would have to have roughly $239 trillion, yes, trillion, sitting in an account right now, earning Treasury rates in order to pay for all the unfunded liabilities or promises, if you will, they've made to Social Security, Medicare, Medicaid, and to cover the interest on the debt. So that would suggest that interest rates maybe aren't actually, or excuse me, not interest rates, the national debt isn't actually 33 trillion, but closer to 240 trillion if you account for all, not to, don't panic, I know, I'm sorry. But so what's the point of all that? The point of all that is tax rates are on sale right now, big time. And there's better times than others to do Roth conversions, but why would you, what I'd ask our audience, why would you want to postpone paying taxes to a future date when they're likely to be higher, potentially stratospherically higher, when you could pay it today at some of the lowest rates we've seen in history? The average top tax bracket in the United States, going back to 1920 or so, is 61%. Today it's 37%. So take the opportunity to cash out, if you will, not necessarily cash out, but to pay the tax at a lower rate and get in a tax-free environment. So that way later on, if tax rates go up, you're okay. Because guess what? You already paid the taxes and you're going to be fine tax-free income.
My gosh, so much great stuff. I feel like we always run out of time. You guys are such a wealth of knowledge, and I know we've got plenty of content for future episodes. But as we close today, what would you want to share with our viewers about what they can expect when they call the number?
So I think it's really important to pick up the phone, call the number, the 866-256-7778, and give us an opportunity to sit down with you, go through your retirement plan, and provide a retirement compass free of charge. There's no cost. The only thing that's keeping you from doing it is you picking up the phone and dialing the number.
Wonderful. Jeremy, Tim, it's always a pleasure to be with you. To our viewers at home, thank you so much for watching. Again, that number to call, 866-256-7778. We hope you found this to be valuable and beneficial. It's how it's intended each and every week, and we look forward to being back with you next week. We love you, Nebraska. Thanks for watching.